In this video, we want to continue our discussion on the framework to financial reporting. We've already established the fact that we have three different frameworks covering the financial reporting, and that has to do with the ethical framework, the regulatory, and conceptual framework. We extensively look at the regulatory framework that has to do with the laws governing or underpinning the preparation and presentation of financial statements. In this lesson, we want to focus on the conceptual framework to financial reporting, the conceptual framework. The conceptual framework to financial reporting basically has to do with the concept that underpin the preparation and presentation of financial statements. It's a body of framework, or it's a reference point when a national preparers or when the International Accounting Standard Board want to issue or revise a standard, make reference to, in order not to provide any piecemeal form of what IFRS. We'll go deeper to see why the conceptual framework and the chapters of the conceptual framework is very, very important. As an accounting student, as a professional accountant, most importantly, those that are in the professional world, those that are practicing accounting, you barely have to know the individual provisions outlined in the conceptual framework, because if you want to treat a particular item and there is no standard for that item, the framework or what you are supposed to use as a reference point in accounting for that particular item has to do with the conceptual framework. The first conceptual framework was issued in 1989, and since then it has received some revision. The most current amendment or revision has to do with the 2018 amendment. So the most conceptual framework we have been amended by the ISB in 2018, March 2018. All right. Now, please take note of this key information about the conceptual framework. The conceptual framework is not an accounting standard. The conceptual framework is not an accounting standard. It's not an accounting standard. Please take note. And in a case where the conceptual framework and individual financial standards are having conflicting issues or conflicting provisions, the provisions in the individual standard overrides that of the provisions in the conceptual framework. But this is always in a rare situation. So in a rare situation where the provisions in a particular accounting standard and provisions in the conceptual framework are conflicting, then we always go for the provisions in the individual accounting standard. Please take note of that. Now, what is the purpose of the conceptual framework? What is the purpose of the conceptual framework? Now, the purpose is to aid the IASB in revising and publishing new accounting standards. In revising and so the focus of the framework, the purpose is to aid what? Is to aid the IASB, the International Accounting Standard Board, in preparing or in issuing or revising the international standards. Again, it's also to help national preparers in accounting for items or accounting for a transaction which does not have a specific accounting standard. In other words, it's also helping the national preparers to account for items or to account for transactions, situations where we don't have individual accounting standards. Another purpose, which is the third one, is that the conceptual framework helps in interpreting and explaining what's the name, the international accounting standards. The conceptual framework helps in explaining and interpreting the international accounting standards. So please take note. As I indicated earlier on, if we have several IFRSs treating several individual items, if there is no framework governing these what's the name, these IFRSs, if there is no framework that we can make reference to when new standards are issued, then the ISB might end up issuing a piece bill or issuing different provisions in different standards that will be conflicting with each other. So to avoid such situations, the framework is to guide the ISB work in order not to provide a piecemeal international financial reporting standards. Now, the conceptual framework is categorized or is organized under 8 chapters. The conceptual framework is organized under 8 chapters. Even until the conceptual framework was, introduced, certain items were not having any definition, or they were not having some information that is needed. For instance, until the conceptual framework, the definition of an asset, liability, equity, expenses, and then income were not explained in any particular individual standard. So the conceptual framework is very, very important. All right. The 8 chapters of the conceptual framework, because so it's organized into 8 chapters. 8 chapters. So once we are done with these 8 chapters, then we are done with the conceptual framework. The first one has to do with the objective of the financial reporting. The objective of the financial reporting. Now, when it talks about the objective, the first chapter is looking at the situation where we want to look at the objective, the sole objective of the financial reporting. And the conceptual framework indicated that the objective of the financial reporting is to provide information about that entity, or to provide information about that reporting entity, which is useful to existing and potential investors or lenders and other creditors in making decisions about the resources provided to entities. So the sole objective here is to provide information about an entity that is useful to existing and potential investors, creditors, and lenders, so that they can use those information in making decisions about the resources they provide to an entity. So the objective is to provide several adequate in-depth information so that this information can be used to make investing decisions and to make lending decisions. And this has to do with the users of the financial statement. And we know we have several users of the financial statement. So that is the objective. The second chapter has to do with the qualitative characteristics of useful financial information. The qualitative characteristics of useful financial information. Entities are required to provide financial information or financial reports at the end of every reporting period. Now, this financial information or financial report being provided must contain or must have certain qualitative characteristics for us to say that those information are useful. And these qualitative characteristics are categorized into 2 main headings or 2 main categories. So we have what we call the fundamental, and then we have what we call the enhancing or supporting, qualitative characteristics of useful financial information. Now, the enhancing has to do with just two. Just two. We are looking at relevance, and then faithful representation, faithful representation, faithful representation. And sometimes we add materiality, add materiality. The materiality is added because for something to be relevant, it depends on its materiality. When you are talking about relevance, it depends on materiality because for something to influence the decisions of end users, and it must be relevant, and that relevance has to do with what? Materiality. Now let's look at what is relevance. Relevance, we say an information is relevant if it is if it's having the potential to influence the decisions of what? Of end users. So we say something is relevant if that information, that report is able to what? Be able to, influence the decision of what? Of end users. Then we say it's relevant. Relevance has two key features. They are what we call predictive value. So relevance is having two key features: predictive value, predictive value, and then confirmatory value. Predictive value and confirmatory value. Now, predictive value is when users are able to predict about what? Predict financial information about the entity or in the future. They are able to predict what will happen in the future. And confirmative value is that they are able to confirm the assessment and evaluations of their predictions. So when we talk about financial information, very relevant, it must contain a predictive value, also contain a confirmative value. That has to do with relevance. Don't forget about the information or the features of a relevance: predictive value and confirmative value. Now, when it comes to faithful representation, financial information provides us information about a phenomenon, about a transaction, about how resources are claimed. So, like I indicated, we see an information is faithfully represented when that information purports to represent what it is representing. So, in a layman's understanding, we are saying that financial statements represent what it purports to represent. Then we are saying that that financial statement is faithfully represented. What it means here is that assuming we have a phenomenon, a transactions that has occurred in the business, is your information that you have provided to end users representing that phenomena, representing that transactions. So the information is faithfully represented when that information represents what it purports to represent. What it purports, the phenomena it purports to represent. And we say it is what? Faithfully represented. Faithful representation have three key features. First, it must be complete. The information must be complete. Let me bring it here. Must be complete, must be neutral, and free from errors. So faithful representation have three key features. It must be complete. That means the information must contain all relevant information, all necessary information for we to say that it is faithfully represented. It must be neutral. That means it must not be biased. You must not provide information to, favor certain group of users. No, it must not be biased. And it must be free from all material errors. So here, materiality is also in place. What errors should be material and what errors should not be material? Now, when we talk about material, it is an entity specific, because what is material to an entity will not be material to other entity. So we say something is material when its omission or misstatement, when its obscuring will affect the decisions of end users. Then we say that is material. So if you go to larger firms, even vehicle is not material to them. A very large firms, vehicle is not material. But if you go to other firms, vehicle is material. So what is material is an entity specific. So that has to do with the fundamental qualitative characteristics. Now let's look at the supporting or enhancing. Supporting enhancing. We have them in four. We have what we call comparability, verifiability, we have what we call understandability, and then the fourth one is timeliness. So we take them one by one. The comparability is that an entity should be able to, compare, or end users should be able to develop trends and patterns between financial statements from one period to another period and from one entity to another entity. When we are doing that, we are saying that we are doing comparability. So users must be able to develop trends and patterns among the entities or from one period to another period. Now, when we are talking about comparability, we clearly have to look at what we call consistency. Though they are not the same, but consistency helps to achieve comparability. Consistency here is that consistency in the methods used in accounting for items from one period to another, or when we are looking at just one period, from one entity to another entity. Comparability can only be achieved when, let's assume, we take one company, they are using the same method. Let's assume they are using cost model to value their PPE. If you go to different company, they are also using the cost model to value their PPE. It is only that we can compare their financial statements and get or make any valuable trends or patterns. So consistency is a very key phenomenon to achieving comparability. Verifiability, the second enhancing qualitative characteristics. Verifiability. Now, verifiability has to say that if you have independent observers and other accountants, they should be able to come into consensus about the information provided by an entity. In other words, we talk about verifiability when the information provided really is about the actual thing that has happened in the business. So you said you have provided us, this is the amount of cash in the financial statement entity. If you go to the business, will we find those cash there? You said that this is the depreciation you have calculated. Will we find it? That is about reaching consensus about the information you have provided. We can verify what you have provided for us. That has to do with verifiability. Financial information should not be provided in jargon notes. It should be provided in ways that are so much difficult to understand. It should be understood by a layman or an individual end user should be able to understand the financial statement. And also, information should be provided at a time that it is what needed. Because if you provide information at a time that is not needed, it becomes irrelevant. Sometimes we are saying that you have to take into consideration cost-benefit analysis. The benefit of providing the information should exceed the cost to achieve cost-benefit analysis. To achieve cost-benefit analysis. Okay, so we can move to the third chapter. So the third chapter has to do with the reporting entity and the financial statement. Now, the reporting entity has to do with any entity that is preparing or is required to prepare financial statements. It can be individual, it can be corporate entities. Then financial statement, the financial statement an entity is required to prepare. The statement of comprehensive income or the statement of comprehensive income, statement of changes in equity, statement of financial position, and the statement of cash flow. That has to do with chapter 3. Then chapter 4 has to do with recognition and derecognition. So chapter 4 talks about recognition and derecognition. Now, when we talk about recognition, it is when should an entity include a particular item in the books of the entity. The recognition has to do with the conditions, such or criteria such items are supposed to meet before they are being included in the books of the entity. While due recognition looks at the contrary, when should we take such assets out of the books of the entity? The standard says that we record or something, an item is recorded when those items are meeting the definition of assets and liabilities. In fact, the element of the financial statement. When such an item is meeting those definitions, then we can include them in the books of the entity. But the conceptual framework goes beyond that by explaining that there are some times where an item will meet the definition of assets, liabilities, equity, income, but yet will not be included in the books of the entity because of certain criteria that it is what it is missing. So you really have to take into consideration the definition and other criteria or conditions that the entity is concerned about before you include such an item in the books of the entity. This combination has to do with when it's not meeting the definition of the element of the financial statement, and you take it off from the books of the entity and you take it. So in view of that, chapter 5 has to do with the element of the financial statement. Element of the financial statement. And there are 5 in number. We have assets. We have assets. We have liability. We have income. We have expenses. And then we have what we call equity. Now, assets is the present resources that is controlled by an entity as a result of past events. So for us to call an item an asset, we must have it presently, and we are able to control it. An entity must be able to control the usage of that item, and this must be as a result of a past event for us to say that there is, or that item is what is an asset. The conceptual framework extensively went ahead to explain what is present, resources, what is control, and what is past event. So please take note of the definition for an asset, because we said for us to recognize an item, we must meet the definition of the element of financial statement. Then liability has to do with a present obligation. That obligation can be constructive or legal. Legal means it's arising as a result of law. It's arising as a result of the contract. The constructive has to do with business practices. Business published policies will warrant that obligation. Then it is constructive. So liability here is either a constructive or a legal, present obligation as a result of what? Past event. As a result of past event, the settlement of that obligation must result in an outflow of the entity's resources embodying economic benefits. So what it means is that if you want to settle that liability, you have to say that that is a liability. If you want to settle that liability, you must lose certain assets which has value, that is resources embodying economic benefits. It is only when certain are present that we can refer to certain item as what? As a liability. If we talk about income are increase in assets, decrease in liability, that results in an increase in equity, other than those resulting from contributions from owners of equity claims. So when we talk about income, they are increase in assets and decrease in liability. We can talk about income to be gains from disposal, revenue from the ordinary activities of the entity. But what we are supposed to note is that if shareholders or the owners of the entity having interest in the business are contributing money to the business, that is not an income, because other than those contributions from holders of equity claims, that is not an income. The opposite works for expenses, is decrease in assets, increase in liability, that results in decrease in equity, other than those distributions to holders of equity claims. So here again, if the entity is paying its shareholders some amount of money in the form of some kind of dividend, that is not an expense. That is why dividend is always not reflected in the income statement. It's treated in the statement of changes in equity. because it's not regarded as what as an expense. Then equity is the residual interest in an entity after taking all the entity's liability from each asset. Whatever is left becomes the residual interest, and that residual interest is what we are referring to as equity. So this has to do with chapter 5, elements of the financial statement. I might not be going chronologically about with the chapters according to how it has been outlined in the conceptual framework, but just follow suit. Just follow suit. Now, chapter 6 has to do with measurement. Measurement. So measurement here, we carry the historical measurement where we are going to use the original cost the asset is what is bought, historical measurement. We can look at also current measurement or current cost measurement. That is when we want to value the asset as at the current price that if you want to sell it or if you want to buy it, you get that particular asset. Valuing the asset at its current price. That has to do with the current measurement. We also have what we call replacement costs. Replacement costs are used or realizable value. They are used when the entity is going into what? Into liquidation. When the preparation of the financial statement is not on the assumption that that entity is of a going concern. Please bear in mind that this conceptual framework, everything I've been explaining so far, it's based on the assumption that that entity is of what is going concern. The entity does not have an intention to curtail its material operations or to go into liquidation. The entity does not have such intention to curtail its material operations or to go into liquidation. Then we are going by this. In a situation where the entity is not a going concern entity, then all these we are saying will not apply. So that is when we use the realizable or realizable value or the replacement cost. Sometimes replacement cost is different from the realizable value, but some books also use them interchangeably. We also have fair value. Fair value have been extensively accounted for under IFRS 13. And I think we have this video on the channel. You can look at the explanation of fair value and what goes into fair value measurement. Then chapter 7 has to do with presentation and disclosure. Presentation and disclosure. Now, presentation and disclosure is how an entity is supposed to present certain items. Which statement are you even supposed to present that particular transaction or that particular item? Are you going to present it in the income statement or you are going to present it in the statement of financial position? That has to be the presentation. Disclosure. Everything that you have done, you have to provide us with a note explaining the treatment, the information you have provided. That has to do with disclosure. And most, in fact, every accounting standard have a disclosure requirement about the important things that goes on in the standard. So as an entity, your financial statement does not end at your last figures. It ends when you are provided as notes explaining those things you've included, those transactions, items you've included in the financial statement. That has to do with the disclosure requirements. Then the last one, the last chapter deals with capital and capital maintenance. Capital and capital maintenance. Now the concept of capital led to the capital maintenance. Now the concept of capital has to do with how much profit is an entity supposed to hold in terms of what its capital. And this concept leads us to what we call the capital maintenance. We have two basic types of capital maintenance. We have the financial capital maintenance. We have the physical capital maintenance. The financial capital maintenance says that an entity makes profit if its opening capital is lesser than its closing capital. In other words, if its closing capital is higher than its capital, its opening capital, then the entity is making a profit. The physical has to do with if the operations of the entity at the closing date is higher, the operation activities we are looking at is higher than its opening operation activity. That has to do with physical maintenance. So the concept of capital brought about the capital maintenance, which has to be financial capital maintenance, and then physical capital maintenance. So these basically the chapters of the conceptual framework. 8 chapters explain the conceptual framework. Please, as an accountant, as an accounting student, you have to have the conceptual framework at your fingertips because it helps you in preparing and presenting a financial statement adequately to an entity or adequately providing the best information to end users. Kindly subscribe if you've not done so and like and share this lesson. Thanks for always learning with us. Still, we are comprehending the complications. Thank you.